Maria opens a $2,000 trading account, drops it into a euro-dollar buy, and steps away for lunch. She never sets a stop loss. She figures the euro will bounce back. It usually does. 40 minutes later, she checks her phone, and half her account is gone. And a trade she never told anyone to close has already been closed for her by the platform itself. She did not get hit by a market crash. She got hit by something called margin. And until today, she had never once looked at what that word actually meant on her own trading screen. By the end of this, you will know exactly why her platform pulled the trigger before she did, and exactly which number on your account is the one thing standing between you and that same phone call. Here is the myth to bust first. Margin is not money you spend, and it is not a fee your broker charges you. It is a good faith deposit, a slice of your own balance that gets set aside, locked in reserve, the moment you open a leverage position. Say your broker offers 50-to-1 leverage. To control a position worth $50,000, you do not need $50,000. You only need about $1,000 of your own cash held back as margin. That locked slice still belongs to you. It is just frozen, doing its job as collateral for the size of trade you are controlling. But if margin is only a slice of Maria's balance, what happened to the rest of it? That is exactly where the terminology most traders skip actually starts to matter. Split Maria's balance into two buckets. The first bucket is used margin, literally the total of every slice locked up across all her open trades right now. The second bucket is free margin, what is left over, the cash she could still use to open a new trade, or the cushion that absorbs losses before they touch the locked portion. When a trade is winning, free margin grows. When a trade is losing, free margin shrinks first, before it ever eats into the used portion. Maria's mistake was not opening the trade. It was never checking how thin that free margin cushion had gotten, while the euro-dollar kept drifting against her. And that cushion is not measured in dollars alone, it is measured as a percentage. And that percentage has a name that decides everything. That percentage is called margin level, and it is the single number every serious trader glances at before anything else. The formula is simple. Take your equity, that is your balance adjusted for any open profit or loss, divide it by your used margin, multiply by 100. A margin level of 500% means plenty of breathing room. A margin level crawling down toward 100% means your equity has shrunk until it barely covers what is locked up. This is the number this whole video has been building toward, because once you can read margin level at a glance, every warning your platform gives you starts making sense before it becomes a problem. This was the gauge quietly dropping on Maria's screen the entire time she was at lunch, and once it crosses two specific lines, the platform stops being a spectator and starts making decisions for you. Pause for a second and guess. Do you think the margin call happens before your trade gets closed, or is it the closing itself? Most new traders guess wrong. A margin call is only a warning, sometimes just a color change on your platform, telling you the margin level has dropped to a broker set line, often somewhere near 100%, though the exact line varies by broker. Nothing closes yet. It is your last chance to add funds or close a losing trade yourself. Ignore it, and the margin level keeps falling until it hits a second, lower line, the stop-out level. That is not a warning anymore. That is the platform automatically closing your open positions, starting with the biggest loser, whether you agreed to it or not. This is exactly what happened to Maria. Her margin level slid from the call line to the stop-out line while she was not watching. The part that actually saves your account from ever reaching that line is coming up next. Here is a live euro-dollar chart, the same pair Maria was trading. Pause this video right now, pull up this exact chart or your own open position, and do the math yourself. Look at how many pips a recent candle moved, multiply that by your position size, and ask how much that swing would shave off your equity. Then check your own margin level on your platform and see how close a move of that size would actually push you toward the call line. Do not just take my word for the formula. Hunt for the moment on your own screen where a real price swing would have mattered. Most traders who go through this exercise once never ignore their margin level again, because the danger stops being a definition and starts being a number they can watch move in real time. Every trading platform puts a small handful of numbers in a corner of your screen, together called your account metrics. Balance is the simplest and worth defining precisely. Balance is the total cash sitting in your account from fully closed trades, deposits, withdrawals, and completed profit or loss. It does not move while a trade is still open. Equity is balance adjusted live for whatever your open trades are doing right now. Then you have use margin, free margin, and margin level, which we already walked through. 5 numbers, but they are not 5 separate stories. They are one story told 5 different ways. Because the moment price moves even a little, more than one of these numbers changes at the exact same time. And that is the part most tutorials skip entirely. Remember, context beats the pattern, the stop is what saves you, and nothing replaces practice on a live chart.